Good afternoon, ladies and gentlemen, and welcome to EPRA's webinar on key listed real estate metrics for better investment decisions. My name is Hassan Sabir. I'm the Finance and ESG Director at EPRA, and today I'll be joined by Simon Robson-Brown, who's a principal at CBRE Clarion Investment, and Bart Geisens, who's the Managing Director at Morgan Stanley. I will also be joined by my colleague, Matt Fletcher, who's the Investment Outreach Director, and he'll be talking about investment outreach activities from the EPRA point of view. So on today's agenda, we'll be talking about the EPRA BPR guidelines, predominantly what the EPRA BPRs are, the EPRA BPR Awards, and the new methodology that was introduced recently. We'll also be talking about the updates that have taken place since 2019. We'll be then moving on to the investor and analyst perspectives, where our panelists, Simon and Bart, will be discussing their approach to EPRA BPRs. We'll then be talking about EPRA sustainability BPRs, as ESG reporting has gathered momentum in the market. We'll be talking about what EPRA's offering on the topic is. And lastly, we'll be talking about EPRA's investor outreach activities. So starting off, why report BPRs? Well, as we all know, IFRS is not industry specific, and EPRA BPRs, as a non-GAAP measure, help investors and analysts gain a better understanding of the company's performance. Reporting according to the EPRA BPRs shows that the company invests in transparency and sends a strong positive signal to the investment community. The BPRs also play an important role in institutional investors' investment process, and they usually provide a first basis for initial screening of a company. So what are the EPRA BPRs? Currently, EPRA BPRs are composed of EPRA earnings, EPRA NAVs, EPRA NIY, EPRA vacancy rate, and EPRA cost ratio. A brief description of what you can see on the screen. In a summary, EPRA earnings is the recurring revenue part of a company's operations. The EPRA NRVs, as they have been updated recently, are showcased by three different metrics, which is the EPRA NRV, NTA, EPRA NDV. The NRV, which is short for net reinstatement value, assumes that an entity never sells the assets and aims to represent the value required to rebuild the entity. The EPRA NTA, which is short for net tangible assets, assumes that the entities buy and sell assets, thereby crystallizing certain levels of unavoidable deferred tax. EPRA net disposal value represents the shareholders' value under a disposal scenario, where deferred tax, financial instruments, and certain other adjustments are calculated to the full extent of their liability, net of any resulting tax. EPRA net initial yield is the annualized rental income based on the cash rents passing at the balance sheet date, which of course will be less non-recoverable property operating expenses divided by the market value of the property, increased with the estimated purchaser's cost. The topped up NIY is the measure that incorporates an adjustment to the EPRA NIY in respect to the expiration of rent-free periods or other unexpired lease incentives such as discounted rent periods and step rents. The vacancy rate is the estimated market rental value of vacant space divided by ERV of the whole portfolio. And lastly, the cost ratios are meant to represent the administrative and operating costs, including and excluding cost of direct vacancy divided by gross rental income. The EPRA BPRs have been in place since the early 2000s. Over the many years, the metrics have evolved to address the market needs, and they're very well adopted by the market. This is shown by the annual survey, which we conduct in conjunction with Deloitte, our external partner. And as you can see on the slide in front of you, over the years, the number of companies reporting EPRA BPRs have increased dramatically. So for example, in 2014, 84 companies were assessed for compliance against the BPR guidelines. And in 2021, it was 181. Moving on to the next slide, I would like to showcase the EPRA BPR Awards. So the awards are meant only to show how a company has complied by the BPR guideline. It does not indicate the quality of the data disclosed, or it does not benchmark against other companies on the quality of disclosure. It is only about compliance with the EPRA BPR guidelines. So the highest award that's possible is EPRA Gold, which requires all 7 performance measures to be disclosed and a combined score of 80% and above. The other 2 awards in the category are silver and bronze. On the next slide, you can see the highlights of the EPRA Awards as in 2021 versus 2015. As you can see, there has been a significant uplift in the number of gold awards, which went from 33 in 2015 to 89 in 2021, and similarly for the bronze and silver awards as well. So this shows the strong performance of the BPRs with the listed real estate sector and the uptake. The next slide again showcases the strong uptake of the BPRs by the listed real estate side. And the graph on the top left side represents the evolution of the total awards and also the number of gold awards received by companies from 2016 to 2021. In the latest survey, 69% of the 181 assessed companies achieved an award, representing 76% by market capitalization. On the next slide, you can see in a bit more detail how the new methodology has impacted the award scoring. So for example, on the left side, you see the graph representing EPRA earnings. So 144 companies reported EPRA earnings, whereas only 126 were considered fully compliant. When I say fully compliant, a company is meant to show the calculation of each BPR. Previously, before this update, if a company just disclosed the EPRA metric, it was given the relevant scoring for that. But since the introduction of the new methodology, companies are expected to disclose the full calculation, otherwise they will not be scored on that. Following up on the updates that have happened, and the recent one was in 2019, and this involved updating the EPRA NAVs. As some of you may recall, EPRA used to publish guidance on 2 NAVs, namely NAV and triple net AV. This has been upgraded to what you see on the screen and is represented by 3 new NAVs. Please note that when we say EPRA NAV, it includes all 3 NAVs. So we strongly encourage companies to disclose all 3 NAVs to be eligible to be considered as having disclosed EPRA NAV. Without going into the detail, the key changes that the new NAVs represent are related to hybrid adjustments, deferred tax connected to fair value changes of investment property, goodwill intangibles per IFRS balance sheet, revaluation of intangibles to fair value, and real estate transfer tax. So these are all key changes in the new NAVs versus the older version. Similar to the NAV update, the EPRA guidelines also incorporated the KPIX disclosure. This has been upgraded from what was previously advised to companies to disclose, and the new KPIX disclosure makes distinction between incremental lettable space and non-incremental lettable space. So we are happy to report that both the changes in the NAVs and the KPIX have been well received by the market, and we've seen significant compliance with BPR reporters. Lastly, as EPRA, we are there to support our membership and the real estate market in general. We provide detailed feedback reports on a yearly basis to help companies improve their BPR disclosure. We also do so by having an online tool where companies can get in touch with us in case of any queries, or they can email us directly in case of any clarification required, or any support they need from us. Moving on. So that was a brief background to the EPRA BPRs, the changes and the new methodology. I would like to now invite and open the floor to our guest participants, Simon Robson-Brown from CBRE Clarion Investment, and Bart Geisen from Morgan Stanley.
Thank you, Hassan. I hope you can hear me okay and see me okay. Good afternoon to everyone on the call. Thank you for joining and thanks for inviting me along today. So I'd just like to give an investor perspective on the EPRA BPR. Some of it might be a little bit repetitious actually of what Hassan just said, so forgive me that. Yeah, but just to give you the sort of the user view, it won't come as any great surprise to you to hear that I'm quite a fan of EPRA BPR. It's a control on financial disclosure. It's a trust builder that ultimately attracts capital to the sector, and that's really what it's all about. Now, I'm probably a fan because I remember the pre-EPRA BPR days and the pre-IFRS days. And I remember going through an Italian property company set of accounts in 1999. It was about 150 pages long. I had to get to page 60 before I found anything that looked like an income statement. There was very little on per share data. Bottom line was, didn't really have very much confidence in the numbers that I was producing from that. So then, as Hassan mentioned, in the early 2000s, I think it was 2001, EPRA kind of got a grip on the issue. And I quote, and this was actually when the global REIT funds were beginning to expand and become truly global. And I quote, one of EPRA's goals is to assist in pushing the industry forward by making the financial statements of public real estate companies in Europe clearer, more transparent and comparable, so that EPRA members collectively and individually improve the reception amongst the investment community. And fundamentally, that's what I think these are doing. I think EPRA has succeeded in that. There's always room for improvement, but I think generally that is what has been achieved. In 2005, IFRS came along and took away quite a lot of the local gap issues that we had, but problems still remained. In particular, there was quite a lot of cost accounting still going on with big depreciation charges going through the balance sheet, which didn't really make sense for an investment company. IFRS was largely format free. You could just do what you wanted, which again wasn't particularly helpful. And in terms of property yield disclosure, that was kind of all over the place as well, between gross yields and net yields. So there was still a role for EPRA to have, and that role is still there. EPRA also raised the bar more generally with the non-financial metrics, or the non-income statement metrics, if you like, things like rental data, lease expiries, development and redevelopment property, like-for-like rental income. So they just raised the bar, and it's difficult to remember now what it used to be like when we just didn't have that kind of stuff. So I'm going to give you 6 reasons why we at CBRE like the EPRA BPR. Slightly repetitious from Hassan's page 4 and 5. 3 of them are quantitative, 2 of them are qualitative, and one's a kind of practical output. So the first one is comparability of accounts. It's fairly obvious, but if you have a rule book, hopefully the disclosure is comparable. If you don't have a rule book, disclosure will diverge and ultimately might become actively misleading, and you get garbage in, garbage out. So without a rule book, some management teams will become quite aggressive in their accounting of the likes of intangible assets, could be goodwill or brand, recurring development profits, stuff like that. So you're going to have one management team becoming quite aggressive in what they disclose in their KPIs. Another team might go down the other route. They may have developments at cost, no revaluation of intangibles, and then at worst, disclosure can become misleading. An example of that could be, for instance, where you have hybrid bonds where the interest on the hybrid bonds isn't being accounted for in any way, or the hybrid bonds are being accounted as equity with no linked increase in the share count. So as a normal equity holder, you're then moving into sort of misleading realm. So comparability is the first one. Second point is enhanced disclosure. If there's no rule book, if there's no control, data points could reduce over time. So EPRA encourages disclosure. It also requires some work. So in order to publish those KPIs, you need to have the controls in place, you need to have the systems in place. Sometimes those KPIs may not be massively favorable, and there might be a temptation not to disclose them. So there will be a gradual erosion over time, if you didn't have the BPR, of what was disclosed to us. So it's just a control on standards. Thirdly, number three, at least on the NAV and the earnings, there is a focus on per share data, not absolute millions of euros or SEK. And I'm noticing a trend actually with fast growing companies who are issuing new equity to grow and acquiring meaningful new portfolios. There is a tendency to concentrate on percentage growth in absolute numbers, profit from property management or EBITDA. There's less focus on the per share number, which is what we own, which is really, really key. And it tends not to grow at the same rate that the EBITDA grows. So the focus on per share data, which EPRA BPR has, for me, is key. So those are the three quantitative things. More qualitatively, it's really handy having a rule book. When you're talking to management, you've been through the numbers, you've crunched the numbers. If you have a standard in place and then the management come in and see you, you can then quiz them on where they divulge from that standard or where the funny looking numbers are. And because you've got that control in place, it actually provides weight to the questions that you're asking. It provides a backbone for you. So I just find it's easier to do the underwriting of the company, and it's much less easy for your questions to be dismissed because there is a standard which the sector uses. You can ask questions, why do you add this number back? Why is this number truly recurring or not? And I find that's a really useful tool. The fifth point is really about trust. Not everybody likes all the BPR. Not every single bit of BPR is going to fit every single company. They're not perfect. But if you are disclosing them, it raises the level of trust. It increases the management score that you have for that company. It shows the company have the systems in place that they need. That hasn't always been the case. It shows management are happy to go back to back with their peers to be compared to them. And it's just a useful tool basically for the more intangible feeling of trust within a management team. And then that leads me to my sixth point, which is the more practical aspect of all of this. When we score companies, without giving away too much of the secret sauce, we look at the valuations against EPRA EPS, the valuations against EPRA NTA, the growth rates of those two, and also a management score. So we actually believe that the EPRA BPR is a driver of the share price. That's what it really comes down to. And we actively use them in the underwriting of the stocks. So just to be a little bit more specific, if you're a small company with a few assets, just an investment portfolio, simple debt structure, to be honest, the EPRA BPR probably don't add too much to that. I think as the companies get bigger and more complicated, that's where the EPRA BPR comes into its own. When things like goodwill hit the balance sheets, a range of capital instruments, development pipelines, fund management arms, increasing joint ventures, intangibles, that's where the assumptions begin to change and it all gets a bit complicated and the accounts get hard to read. And that's where EPRA BPR really comes into its own. Specifically on the income statement, there's been a rise of FFO or companies reporting what they call FFO, particularly amongst the German residential names. As far as I can tell, FFO is unconstrained. Companies can pretty much do what they want to come up with a number that they want, and there isn't the control that you need that EPRA BPR has. I don't really know why FFOs come to the fore. It's actually quite similar to EPRA earnings, and companies can disclose their own adjustments beyond EPRA earnings. So I'm not actually a great fan of this new FFO that's sort of been imposed on us. I'll flesh that out, actually. And then on the balance sheet, as I said, there's goodwill, revaluation of intangibles, treatment of hybrid bonds and D shares and the like of that. That's coming to the fore. Sometimes minority interests get confused. And for non-REIT markets, like German Resi and the Swedes, there are large deferred tax liabilities as well, which a lot of assumptions come into that. So that's something to keep an eye on. Nothing is perfect. There are areas where we need to keep on top of. I'm thinking in the income statement, non-recurring items sometimes kind of become recurring. So that's something which happens quite a lot, like write down of tenant incentives or repeated redundancy or restructuring costs. So it's sometimes a bit grey what's recurring and what's not recurring. And then on the NAVs, we seem to have an inconsistent approach on transfer taxes right now, where some companies add them back as they're allowed to do in NTA, and some don't. So we still need to maybe make our own adjustments to the EPRA BPR just to get to something that's truly comparable. Now, Hassan, if you could go to the next slide. I've tried to flesh some of these issues out, and I've got an EPRA earnings slide, I've got EPRA NAV, and I've got EPRA yields. So what we have here is a recreation of the Vonovia 2020 income statements, IFRS, FFO, EPRA, and then the CBRE one. We don't get this. I've had to back this out from the EPRA disclosure. Now, the EPRA disclosure starts with the reported net IFRS number and then reconciles back to EPRA. Now, I've flipped that on its head and I've basically recreated the income statements, because I think this is an easier way to immediately at a glance see what's included and excluded from each. So first of all, on the FFO, and this is a particularly German thing, but on the FFO, you can see pretty much straight away that it's recurring development sales, which are included net of tax, but included in FFO and excluded from EPRA. Maybe that's fine. A house builder, it's all it does is build houses and sell houses. So that is a recurring income, but it's a different quality income. It's a different risk. And the FFO number just sort of walks over that, whereas the EPRA number highlights it. So the difference between the two highlights there's a different risk metric going on between the earnings number. If you go further down the income statement to the depreciation line, FFO doesn't have any depreciation in it, which I just think is nuts. I don't get it. That just goes against the accounting, the basic principle of accruals in accounting. At no point does FFO, in this case, take the cost of equipment, cars, air conditioning, whatever. That is excluded from FFO, which just feels wrong, whereas EPRA includes that. The final adjustment that CBRE makes is the hybrid debt interest, because we're looking at it from a normal equity basis. So we strip out the hybrid debt interest expense as well. So that's my point. We still need to make small adjustments, maybe to the EPRA number. And the punchline of this is the EPRA number is 11% below the FFO. And I think it's reasonable to say that the true equity return is 14% below the FFO, which is a couple of years growth. So I think it's a material thing. Okay, moving on to the NAV. I've done a similar thing. I've recreated the balance sheet. I'm not going to make a call between NRV, NTA, and NDV. They're all trying to do slightly different things, and you can choose whichever one you want. They're all just a bit different. But I think if you can read it on the screen, hopefully, what this does do is just immediately highlight what is in each of them. And also doing this analysis actually highlights funny looking numbers as well. It's actually quite useful. So just to quickly look at the NRV line, you can see goodwill is in there. This is the net realizable value. This is the proxy for what it would cost to recreate the company from scratch. You've got goodwill in there, which is a completely management controlled number, depending on what they pay for an asset which they bought over book. So there's a lot of hot air in there. There's intangibles, there's the revaluation of the value add bid business in this case, which is 4.6 billion euros. So it's actually quite a big number in this case. Just going down the list, there is a funny in here. Vonovia have added back 988 million of deferred taxes over and above what was in the balance sheet in the first place. And I'm not quite sure how that can be. So this is an example of a weird number where I can now use EPRA and show this to management and say, what's going on there? That's a bit weird. Again, the punchline here is that the NDV is 42% below the NRV. Massive spread. To their credit, maybe Vonovia actually point to the NTA, but they are quite aggressive in including transfer taxes in that, which other companies wouldn't do. They are allowed to do it, no problem, but it's a more aggressive treatment that other companies have. And then lastly, moving on to the EPRA yields. One of the most frequent questions I have is, what is the implied cap rate of the sector? What's the implied cap rate of retail, the implied cap rate of industrial? It's a very easy question to ask and very difficult to answer, because you're like, well, okay, what yield are we talking about? Which one? So EPRA was particularly helpful in coming up with the different types of yields, the net initial yield and the top yields, just to cut through the noise. Is it gross? Is it net? Those are the sort of issues we've had before. And the spread between the net initial and the topped up is actually quite large. Here we've got Vonovia, Derwent London, Great Portland, and a stock I've called Swede number 1. And you can see, particularly for Derwent, how important the tenant incentives are. You know, moving the net initial from 3.7 to 4.8. If we didn't have these rules, it could well be that all we would get would be the equivalent yield, which isn't even on this page, but an even higher yield. And then it really is garbage in, garbage out. You really just don't know whether you're working on comparable data. So again, for me, this is a really important yield. And there would otherwise be a tendency for companies just to give the highest yield. So hopefully that's given you a flavour of where CBRE